earnings and the opportunities that come from overreactions on the up and the downside. Let's bring in our friend Stephanie Link, Chief Investment Strategist and Portfolio Manager at Hightower, as well as a CNBC contributor. Hi, Steph. How are you?
I'm good. How are you?
I'm pretty good. Thank you very much. Let's talk about the economy and bond yields. I mean, a lot of people think my basic question is, when are interest rates going to start to slow the economy, or have they already? We know they've slowed the housing market, but elsewhere the economy seems pretty strong. Can we continue to expect that?
Well, the economy is certainly chugging along, and that's been because the consumer has been resilient, and that's because jobs are still plentiful, right? And wages are actually higher, and inflation is coming down. So real income is actually going higher. And believe it or not, the consumer continues to spend. We got the retail sales data that was over double the expectations last week alone. So I think the consumer is pretty healthy, but we know that higher rates are eventually going to eat into the economy. It's just the big question is by how much. And because we know the third quarter is going to be quite strong.
Yeah,
we get third quarter GDP
good, right?
this week. Yeah, yes. Third quarter is going to be good, but how much do we slow in the fourth quarter? That's the question. Do we slow at all? And that's why it goes back to what you mentioned earlier, earnings. So that's what we're all listening to, because so far the earnings are coming in better than expected. It's a small sample set, but almost 80% are beating. Now we have to listen to what the companies have to say. So far, none of the companies, including the banks, are saying that there is this massive slowdown coming. It'll come, but we don't know to the degree.
Mike, how do you react to what Steph just said there about earnings and where they are and the outlook for 2024 as we get ready to turn the calendar page?
Well, yeah, I mean, while we've all justifiably been focused on a lot of these macro intermarket factors with bonds versus stocks and everything else, the earnings trajectory has inflected higher. We do see the consensus building toward growth in 2024. To me, the real question that this earnings season has to answer is the first half of 2024, are those numbers plausible or not? So I think it's going to take the full season to get some better sense of that. But it also gets back to the underlying economy, because I think a lot of those forecasts are based on, the economy continuing to do reasonably well. And I think that we've been just on alert for some kind of either financial accident because of the fast moves in yields, or just that effect flowing through in the cost of capital that might impinge on stuff. But again, I really think that we have sticker shock at near 5%, even though in the abstract, that's not some number that we should necessarily feel is incompatible with a steady economy.
I'm a little unnerved, Mike, by the uninversion of the yield curve. It's now almost complete, and you kind of like peering around the corner going, we know what normally happens next.
We do. If there's anything we can sort of project on normal versus this cycle, I think it is a reason to be on alert again. And now it's happening through a different dynamic, as many have pointed out. It's not as if short-term yields are crashing because the Fed's got to cut into a weakening economy. That's usually the way it's happened ever since, let's say, the last 50 years in this cycle. But you're absolutely right. It's all of it is kind of the ground's moving a little too fast under people's feet. And so whatever the actual set of factors driving yields in this direction, it could have a little bit of a challenge set up for us in terms of how the economy digests it.
Well, in the near term, Stefan, at least it will take, if the long end is kind of put in the highs for this recent move, you have to think that's going to help, along with the earnings that you mentioned, for at least the near term.
It should, but the problem, Kelly, for stocks is now there is an alternative. Even if yields were to pull back a little bit to the 4% level, there's still competition, and there hasn't been competition for 10 years for equities, right? It was the only game in town. And so now there's a strong rationale for 60-40 asset allocation, or 70-30, where before it was like 100% zero, right? So that's what is the conundrum for the overall market. But I do believe that earnings are going to be good this quarter because the economy is held up. And I think they'll be good even into the first half of next year. And then I think it's the second half of 2024 that I'm going to be watching for any clues on a slowdown in the economy as well as in earnings.